So the most important part of this whole process of retirement withdrawal strategies is the tax efficient decumulation. And that's really what we're after. We're after how can we save the most money in taxes by decumulating or spending down your retirement assets most efficiently. And the very first thing that we want to cover here is your streams of income. So obviously, there's nothing you can do. If you've got Social Security, for example, or a pension, that is just going to come out of your portfolio, or out of your retirement plan, and there's nothing you can do about that. Number two would be your required minimum distributions. These are assets that, again, you have no control over. The IRS forces you to take money out of your retirement accounts that are pre-tax, your IRA, your 401k, once you hit age 72. It was age 70. Now it's 70 and a half. Now it's 72 under the new Secure Act. So you cannot control that. So these two things are first and foremost, you can't do anything about those. Number three is you've got your distributions. And what I mean by this is your taxable account. Your taxable account is going to give you a 1099 each year. And that 1099, so it's just a joint account or maybe a trust account or a single account. But that account, that investment account, is going to give you a 1099 each year. And those distributions, the capital gains, the dividends, the interest income that comes out of that account, you can't control that either. It's already in the taxable account. So these first three things are things that you just cannot control. If you need $100,000 in income and these things amount to $50,000, well, that's your first low-hanging fruit. Number four is you need to consider your taxable portfolio according to Vanguard. And I do agree with Vanguard to some extent. However, I will go into a little bit greater detail on where I disagree. But you need to consider your taxable accounts, that account that these distributions came out of. Maybe it makes sense if you need $100,000 and you already got 50 to liquidate the other 50 from the taxable account. And that won't force any distributions from other pre-tax or tax-free accounts. But then it comes down into a little bit more complicated decision process. So once you've handled that low-hanging fruit, as I erase my whiteboard here, once you've handled that low-hanging fruit, you have a decision to make. Will taxes be higher in the future, or will taxes for you be lower in the future? And what I mean by this is, what is your expected rate of tax payment, let's just say 2 years, 5 years, 10 years, 20 years down the road? If you expect your taxes to be higher, for example, and let's just say you're paying a blended rate of 20% now, if you expect that to be 22 or 25, then what you really want to do is take that money out of the IRA, the pre-tax accounts, IRAs, 401ks, things like that. Because why not pay the taxes now at a lower rate? Phase two of this decision is if you expect taxes to be lower, you want to take these next chunks of money or next distributions out of the Roth IRA. Why? Because taxes will be lower in the future. Why pay a higher tax rate now? So this is actually the fifth step in this whole process. And real quickly, just to surmise again, you can't control your pensions, your Social Security, those income streams. They're coming to you no matter what. That's the low-hanging fruit. The second part is the required minimum distributions from your pre-tax accounts like an IRA or 401k. Again, low-hanging fruit. You can't control it. There's your spendable cash. Finally, you want to take your distributions, income payments, dividends, and interest income from your taxable account that may be, maybe a joint account, trust account, a single account. You can't control that. There's nothing you can do. So that adds on to your base level of income. And then you might also, number four, consider selling assets out of those taxable accounts to reduce those dividend distributions and income payments and so forth. And you don't have to pay taxes on those dollars. And that would be phase four of this. And finally, phase five, as we come to here, do you expect your taxes to be higher in the future? If so, take the rest of your money out of the IRA for that year. If you expect your taxes to be lower in the future, then you may want to take those monies out of the Roth IRA. And again, I'm going to go into a little bit greater detail on why I disagree with this process. Although it's generally very good that Vanguard's created, I disagree with the process because it's not taking into consideration things like tax brackets. And there may be a point where you would want to take a portion out of your IRA and a portion out of the Roth just to avoid jumping into the next bracket. Or additionally, you may want to consider Roth conversions. If you've got taxable dollars to pay the taxes with especially, you may want to consider Roth conversions as part of this process of a retirement withdrawal strategy. Even though it's not really a withdrawal strategy today, it will affect your withdrawal strategy in, let's just say, 2, 5, 10, 20 years from now.